HCL Tech reported a great set of numbers. The constant currency growth came in at 5%, much ahead of street estimates, led by the products and platform business of the company, as well as the margin surprise of an improvement of 160 basis point thereabouts is something that the street definitely liked. But what about the outlook and what about FY24? Because that's the key question that the market really wants answered. Let's get that going and ask these questions to the management at HCL Tech. We are now joined by C. Vijayakumar, the CEO and MD, as well as Prateek Aggarwal, the Chief Financial Officer at HCL Tech. Gentlemen, hi, good morning. Thank you so much for making time and speaking with us. CVK, first up the question to you. You have, of course, narrowed your guidance a tad bit as far as revenue is concerned, and this is after a solid beat in Q3. The ask rate for Q4 is not that high. It's actually at a decline of minus 1.5% to just about flat. Are you calling out any headwinds in Q4 apart from seasonality?
First of all, Anisha, we delivered a very strong quarter, strong performance across all metrics, revenue growth, margin expansion, strong booking growth, net addition, lowering attrition. So on all metrics, we delivered exceptionally well. It's a quarter of great execution, and we are very happy about that. Now, with respect to the guidance and the expected growth rates, I don't think it's a decline. I think it's Prateek can exactly comment on the overall metric, but our services business, we expect it to grow quite well, and product business will moderate. There is a huge uptick in this quarter, so Q4 is a seasonally weak quarter for the product business, so that will moderate in Q4.
Let me actually scratch that point further, Prateek, with you as far as the margin guidance for FY24. Let me rephrase the question. Let me scratch that point further with respect to the margin as well, because your margin guidance has also been narrowed to 18 to 18.5%, and then the ask rate for Q4 becomes a decline of 200 basis point to a flat rate. Apart from the fact that there was actually furlough impact in Q3, plus there was some wage hike component as well. What is that you are worried about in Q4 that might impact the margins negatively as well?
It's the same factor which is affecting the top line, right? I mean, in the software products, in the software business, the incremental 100 million that I talked about, a lot of it, maybe 80% of it or thereabouts, flows down to the bottom line EBIT as well. So that will not be there next quarter. So that's the reason we are publishing the services P&L, I mean, EBIT as well. I mean, there are two segments within that, and the services number we publish as well. So that has grown from 17.6% last quarter. It grew to 17.7% this quarter. And that is after absorbing a wage increment of 70 basis points. So actually, without wage increment, it improved by 80 basis points. So that is the way to track the services business, which is close to 90% of our overall company revenues. And that hopefully should keep improving like we have talked about earlier as well. But the software business can't continue with the 32.6% that they declared this quarter, which was a 1% increase on a year-on-year basis with the same seasonality in December 21 quarter last year. So that has also grown 1%, but you can go back to the March quarter software numbers of last year and see it wasn't anywhere near 32%.
Sure. No, so of course the seasonality comes into the PNP business, but CVK, let me talk to you about the entire demand environment. You had earlier called out some weakness in BFSI, retail as well as high tech. How are you seeing things on the ground at the moment with respect to how demand environment is shaping up in all of these verticals now?
Yeah, so Nisha, we need to look at this from some immediate kind of challenges, and then what is the outlook from a mid to long-term perspective. I think being the year end, there is some seasonality. So that's why we called out a few sectors which had higher furloughs and a little bit of ramp downs. So that was the commentary. But as we move forward, we see two broad themes, like everyone in the industry is also seeing. One is cloud adoption and digital transformation, which is led by digital transformation led by IT operating model change and accelerating cloud adoption, right? There is one set of opportunities which is very strong and which continues to be strong uh, uh, across multiple verticals. The second set of opportunities are really driven around more automation and higher levels of efficiency, what the industry calls as a cost takeout opportunities. So there we see a number of opportunities which are in the early stages in our pipeline, and some of that will start maturing in this quarter and result in conversions in the first half of FY24. So if I were to characterize it, little bit moderation in discretionary spend is happening in the industry, but I think there is even bigger opportunity on vendor consolidation, cloud migration, and more efficiency-led opportunities. So I think overall outlook for the industry, as I said, mid to long term, it continues to be a very strong outlook. There can be 1 or 2 quarters where when there is a moderation in the discretionary spend, you will need to do a little bit more bookings to really kind of offset that moderation. And that's what we're all working on.
So just to put that in perspective, CVK, you are saying that there is maybe a bit of a moderation in discretionary while there is more opportunity when it comes to vendor consolidation, optimization, etc. So on a net basis, what should we expect with respect to the deal wins going forward? Would it continue to be in the $2 to $2.5 billion range per quarter?
Yeah, I think as I mentioned in the yesterday's call, our goal is to get to at least a 10% year-on-year growth in the bookings. So that's really what we are working on, and which means we're already running at 2.3, 2.4, and with a little more opportunities in the horizon, that should inch up as we move forward.
Okay. Prateek, let me talk to you about the cost side of things. With respect to the margin, a big jump this time around, and you did call out how the seasonality will come into Q4. But with respect to subcontracting costs, travel costs, etc., do you think they have normalized, or there is still some pressure that you can expect with respect to, let's say, travel costs and normalization post-COVID?
I think there is a little bit more to come, because this quarter, while travel cost did not increase sequentially, that is attributed to December being a lean month in terms of business activity. So there will be a little more uptick on the travel, and some of the savings that we had during COVID, some of that will come back. So I think there is a little bit more to come. But I think the biggest levers for our profit improvement to get back to the pre-COVID levels, I think we continue to focus on realization. We have increased the prices from the first of last year, which is almost now 12 months now. And the fresher absorption, we expect to hire similar number of freshers in the next financial year. So that is going very well. Then, of course, there is some more levers of better utilization and more automation and managed services opportunities. So all of that generally will reflect positively for the margin trajectory as we move forward.
Okay, so the margin trajectory also has a lot of levers. But Prateek, let me come to you and understand the free cash flow generation has been quite strong. You had recently reiterated as well with respect to the payback that you want to do to the shareholders as well with respect to your capital allocation policy. Any indication in terms of which route would you take? Is buyback something which is on the mind and on the cards, or is it going to be special dividend?
So, Anisha, we have been very steadily paying 10 rupees per quarter on the trot, and with our last 12 months EPS at 53.36, we are already running at that 75%, minimum 75% that we committed to. And, given that we are doing it so steadily every quarter, rate kind of a thing, the buyback kind of a spike typically is not called for. We always obviously never say no kind of a thing, but we are paying out pretty much 75% or more every quarter on the trot.
Sure, point taken. Slow, like steady is better than perhaps that one blip that you were pointing out. But Prateek also wanted your take regarding pricing. Now, CVK did point out that realization has improved, and last year in the month of January, you had increased the price card as well. Is there any increase which is likely this year in the month of January as well? And with respect to the new deal wins which are coming, especially on the vendor consolidation and cost takeout bit, is pricing where you want it to be, or the increased competition is limiting the pricing opportunity for you?
So as of now, we continue to gain on the price realization. We gained about 100 basis points last quarter meaning September quarter. And this quarter, December quarter as well, we gained about 30 plus basis points. So, that continues. That is more probably because of the composition of the newer deals becoming higher every quarter, plus some benefits we are able to get during the quarter as well. So both the factors are delivering that, and we continue to hope to work and get more of that every quarter. Regarding the vendor consolidation deals, most of them are more in the preliminary stages right now. We'll have to wait and see where that gets us. Whatever we've got so far, the mega deal that we announced last quarter and whatever deals, 2.35 billion we've announced this quarter, have all been at good rates. I don't see any issue